Alright, so in today's video, we're diving into a really important conversation happening right now on Wall Street. We're going to look at a recent CNBC halftime committee discussion, where top investors are debating what this fragile ceasefire in the Middle East actually means for the stock market, and more importantly, what it means for your money. This isn't just about geopolitics, this is about market psychology, earnings, interest rates, and where smart money is positioning right now. In a moment, I'm going to play you the key clips from that discussion, and then after that, I'll come back and break everything down for you. Not just what they said, but what it really means, and how you can think about it as an investor. If you get value from this video, like, share your thoughts in the comments and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Now, let's watch the video. The first thing that stood out to me, and this is critical, is this idea that the market is no longer reacting negatively to bad news. That's huge, because historically, one of the clearest signals that a market bottom is forming is when bad news stops pushing prices lower. Think about what they said. Tensions in the Middle East were escalating, oil prices were rising, and yet, stocks weren't collapsing. Now, on the surface, that might seem strange. You would expect markets to panic in that kind of environment. But instead, what we saw was resilience. And in my opinion, that's not random. That's positioning. That's institutional investors saying, we've already priced in the worst-case scenario. And when that happens, the market shifts from being reactive to being anticipatory. So when Tom Lee says the bottom might already be in, he's not just making a bold prediction. He's pointing to a very specific behavioral shift in the market. And I actually agree with the logic behind that, even if I wouldn't go as far as saying the bottom is 100% confirmed. Because here's the reality. Markets don't bottom when things feel good. They bottom when things stop getting worse. And that's exactly what we might be seeing right now. Now, Josh Brown added another layer to this that I think is even more important, and that's the idea of positioning extremes. He talked about how investors were piling into puts, moving heavily into cash, and essentially bracing for further downside. That's fear. That's defensive positioning. And here's what a lot of people don't realize. Markets often move in the opposite direction of the majority's positioning. So when everyone is hedged, when everyone is cautious, when everyone is expecting more downside, it doesn't take much positive news to trigger a move higher. And that's exactly what we're seeing now. A ceasefire, even a fragile one, becomes the catalyst. Not because it solves everything, but because it's less bad than expected. And in markets, less bad is often enough. Now let's talk about something else Josh mentioned, earnings revisions. This is where things get really interesting, because while all this geopolitical uncertainty is happening, analysts are still raising their earnings expectations. Let that sink in for a second. You've got war headlines, oil volatility, macro uncertainty, and yet corporate earnings expectations are still trending higher. That tells you something very important about the underlying strength of the economy, because at the end of the day, the stock market is driven by two main things, earnings and interest rates. And right now, earnings, at least on paper, are holding up extremely well. Now, personally, I think this is where you need to be a little bit careful, because analysts tend to lag reality. They often stay optimistic until companies themselves start guiding lower. But at the same time, the early signals we're getting, like positive pre-announcements and strong commentary from companies, suggest that businesses aren't seeing a collapse in demand. And that's key, because if earnings don't collapse, then the justification for a major market sell-off becomes weaker. Now let's connect this to the consumer, because this came up in the discussion as well. They talked about this idea of a K-shaped economy, and this is something I've been saying for a while now. Not all consumers are struggling equally. You've got one segment, typically lower-income consumers, who are feeling the pressure from inflation, higher interest rates, and rising costs. But then you've got another segment, higher-income consumers, who are still spending. And in many cases, they're spending a lot. So when companies like airlines or retail brands say the consumer is still in good shape, what they often mean is that the higher-end consumer is still driving growth. And that creates this uneven dynamic in the economy. Now, why does that matter for investors? Because it tells you where the strength is. It tells you which companies are more likely to outperform. Luxury, premium services, travel, high-end retail. These areas tend to benefit from that resilient upper-tier consumer. And that's something I personally pay close attention to when thinking about where to allocate capital. Now, another point that came up, and this is subtle but important, is how close the market is to all-time highs. They mentioned that the S&P 500 is only about 2.5% away from its peak. Think about that. After everything we've been through, geopolitical tensions, rate hikes, inflation concerns, the market is basically right back near its highs. That's not a weak market. That's a market that wants to go higher. But, and this is where I want to add my own perspective, just because a market wants to go higher doesn't mean it's going to do so in a straight line. And this is where I think a lot of investors make mistakes. They see strength, and they assume it means smooth sailing. But in reality, markets can grind higher while still being volatile. And that's exactly what one of the panelists pointed out. Volatility is probably not over. We could still see sharp moves, pullbacks, rotations between sectors, especially as we move into earnings season. And this is where things get really interesting. Because earnings season is where narratives get tested. It's where expectations meet reality. And if companies deliver strong results, especially in sectors like technology, that could be the fuel for the next leg higher. But if we start to see cracks, if guidance weakens, if margins come under pressure, that's when volatility can spike again. So in my view, this is not a set it and forget it market. This is a market that requires attention. It requires understanding where the risks are and where the opportunities are. Now let's talk about something Malcolm Etheridge said, because I think this is one of the most honest takes in the entire discussion. He basically said, a lot of this move could simply be FOMO, fear of missing out. And I think that's absolutely true, because we've seen this before. When markets snap back quickly, when you get these sudden rallies, there's always that moment where investors who stayed on the sidelines start to panic, not because they're afraid of losing money, but because they're afraid of missing gains. And that can create a self-reinforcing cycle. People buy because prices are going up, which pushes prices even higher, which attracts more buyers. And before you know it, you've got momentum. Now, is that sustainable? That's the big question. Because FOMO-driven rallies can be powerful, but they can also be fragile. They rely on continued optimism, continued inflows, continued positive headlines. And if any of those start to fade, that's when things can reverse quickly. So personally, I think it's important to participate in the market, but not blindly chase it. There's a difference between being invested and being reckless. And in an environment like this, discipline matters more than ever. Now, let's also touch on sector positioning, because this is another key takeaway. They mentioned that tech and financials are where a lot of the opportunity is right now, and that makes sense. Those were some of the sectors that got hit the hardest during the uncertainty. So naturally, when sentiment improves, that's where money flows back in. But again, this comes back to positioning. It's not just about which sectors are good, it's about which sectors were oversold. Because in the short term, markets are driven as much by positioning as they are by fundamentals. And right now, we're seeing a rebalancing. We're seeing investors move back into areas they previously avoided, and that's creating these sharp moves. One of the biggest variables that came up in that discussion, and one that I think a lot of retail investors underestimate, is interest rates. More specifically, bond yields. Because while everyone is focused on the ceasefire, geopolitics, and headlines, the bond market is quietly dictating the rules of the game in the background. And one of the panelists made a very important point, that for a true, sustained bull market to take hold, yields need to come down. Now, why does that matter? Because interest rates are essentially the gravity of the stock market. When yields are high, they pull valuations down. When yields fall, they give stocks room to expand. It's that simple. So when they were talking about the 10-year yield being around that 4.3% to 4.5% range, that's not just some random number. That's a pressure point. Historically, when yields start pushing above that 4.5% level, equities begin to struggle. You start to see cracks in growth stocks, pressure on valuations, and a general tightening of financial conditions. But what's interesting here is that even during the height of the geopolitical tension, yields didn't spiral out of control. They spiked briefly, but then they stabilized. And in my opinion, that's a big reason why the market held up as well as it did. Because if you had rising oil prices and surging yields at the same time, that's when things can get really ugly. That's when you get that double pressure effect on the market. But we didn't quite get there, and that's why I think the market avoided a deeper sell-off. Now, going forward, this is something I'm personally watching very closely, because if yields start trending lower, let's say back toward that 4% or even 3.75% range, that could be a major tailwind for equities, especially for growth stocks, especially for tech. And that ties directly into another point they made, which is that technology is likely to lead the next move higher. Now, this isn't a new story. We've seen this before. Tech leads on the way up, gets hit the hardest on the way down, and then leads again in the recovery. But here's where I want to add a bit of caution, because not all tech is created equal. There's a big difference between high-quality, cash-generating tech companies and speculative, unprofitable names that rely heavily on cheap capital. If rates stay elevated, even if they don't go higher, that second category is still going to struggle. So when we talk about buying tech, we need to be specific. We're talking about companies with strong earnings, strong balance sheets, and real demand, not just hype. Now let's shift to oil, because this is another critical piece of the puzzle. One of the analysts mentioned that for a sustainable bull market, oil prices likely need to come back down to around $70. And that makes sense, because oil is like a tax on the global economy. When energy prices rise, it increases costs for businesses, it squeezes consumers, and it puts pressure on margins. So even though energy companies might benefit in the short term, the broader market tends to struggle when oil stays elevated for too long. Now, with this fragile ceasefire, the expectation is that tensions ease, supply concerns stabilize, and oil prices come down. But let's be real for a second. This is the Middle East. Stable is always temporary. And this is where I think the market might be a little bit optimistic. Because while de-escalation is happening now, it doesn't mean the risk is gone. It just means the rate of escalation has slowed. And markets are very sensitive to that rate of change. So if things continue to cool down, even slightly, that's bullish. But if tensions flare up again, that could quickly reverse sentiment. And this is why I think volatility is still very much in play. One of the panelists said it clearly, even if the bottom is in, that doesn't mean we go straight up from here. We could easily chop around for a while. And honestly, that's probably the most realistic scenario, because you've got competing forces right now. On one side, you have strong earnings expectations, resilient consumers, and improving sentiment. On the other side, you have geopolitical uncertainty, elevated interest rates, and potential inflation pressures from energy. So what does that create? It creates a market that moves in waves. Up one week, down the next, sector rotations, sharp reactions to news. That's the kind of environment we're in. And if you're not prepared for that, it can shake you out of your positions. Now let's talk about something else that I think is really important. And that's this idea of what actually defines a new bull cycle. Because there was some skepticism in the discussion about whether we're truly out of the woods. And I think that's a fair question. Because calling a new bull market too early can be just as dangerous as staying bearish for too long. So what would I personally look for to confirm that we're in a new sustained uptrend? First, I'd want to see consistency in earnings. Not just one or two strong quarters, but a clear trend of growth across multiple sectors. Second, I'd want to see some stability, or ideally a decline, in interest rates, because again, that's the foundation. Third, I'd want to see broader participation in the market. Not just a handful of mega-cap stocks carrying everything, but a wider range of sectors contributing to the upside. And finally, I'd want to see sentiment shift, but not become euphoric. Because here's the thing, the best bull markets don't start with euphoria. They start with skepticism. They climb what people call a wall of worry. And right now, I'd say we're somewhere in that early phase. There's still doubt. There's still hesitation. There's still a lot of people sitting on the sidelines. And that, ironically, is what can fuel further upside. Because those sidelined investors eventually come back in. They redeploy cash. They chase performance. And that adds momentum to the market. But again, it's not a straight line. Now let me give you my personal take on how I would approach this environment, because this is where strategy matters. For me, this is not a time to go all in, and it's not a time to sit completely out. It's a time to be selectively aggressive. What do I mean by that? I mean focusing on high-quality companies, strong earnings, strong positioning, while still keeping some cash on the side. Because opportunities will come, pullbacks will happen, and when they do, that's when you want to be ready, not scrambling, prepared. I also think diversification matters more right now, because with all this uncertainty, you don't want to be overly concentrated in one theme or one sector. Yes, tech looks strong. Yes, financials are recovering, but that doesn't mean you ignore everything else. Balance is key. And finally, I think patience is underrated in this kind of market, because when things are moving fast, when headlines are constantly shifting, it's easy to feel like you need to act on every piece of information. But sometimes, the best move is to stay disciplined, stick to your strategy, and not get pulled into the noise. All right, now let's bring all of this together, because this is where the real opportunity is, but also where the biggest mistakes tend to happen. At this point, we've talked about the ceasefire, market resilience, earnings strength, interest rates, oil, and positioning. On paper, things are starting to look constructive, but here's the truth most people don't want to hear. This is also the exact type of environment where investors get trapped. Not because the market is weak, but because it's confusing. Because when you have a market that's grinding higher while uncertainty still exists, it creates emotional conflict. You're not fully confident buying, but you're also afraid of missing out. And that's where bad decisions happen. So let's talk about the biggest risks right now, not just in terms of the market, but in terms of investor behavior. The first risk is assuming the situation is resolved. Yes, we have a ceasefire. Yes, tensions are cooling, but this is still a fragile situation. Geopolitical risks don't disappear overnight. They evolve, and the market can flip very quickly if headlines change. So if you're investing right now with the mindset that everything is fine, that's dangerous, because the reality is the market is pricing in improvement, not perfection, and there's a big difference between those two things. The second risk is overreacting to short-term moves. Like we talked about earlier, this is likely to be a volatile market. You're going to see green days that feel like the start of a breakout and red days that feel like the beginning of a crash. And if you let those short-term moves dictate your decisions, you're going to get chopped up. This is where discipline comes in. This is where having a plan matters more than ever. Because without a plan, you're just reacting. And reactive investors usually lose. The third risk, and this is a big one, is chasing momentum blindly. Now don't get me wrong, momentum is real. It's a powerful force in markets. But there's a difference between understanding momentum and chasing it without context. Because when you chase, you're usually late. You're buying after the move has already happened, and in a volatile environment, that can backfire quickly. So instead of chasing, you want to anticipate. You want to identify where money is likely to flow next, not where it's already gone. And this is where I think a lot of people are missing the bigger picture. Because while everyone is focused on the immediate rebound in tech and financials, the real question is, what happens next? Do we see rotation into other sectors? Do we see laggards start to catch up? Do we see defensive areas come back into favor if volatility spikes again? These are the questions that matter. Now let's talk about the psychological traps, because honestly, this is where most investors lose money. The first trap is recency bias. People assume that whatever just happened is going to keep happening. So if the market has been going up, they expect it to keep going up. If it's been volatile, they expect chaos to continue. But markets don't move in straight lines. They cycle, and understanding that cycle is key. The second trap is confirmation bias. This is where people only look for information that supports their existing view. So if you're bullish, you focus on the positive data. If you're bearish, you focus on the risks. But the best investors, they look at both. They challenge their own assumptions. They ask, what if I'm wrong? And that's something I try to do constantly. Because in a market like this, being open-minded is an advantage. The third trap is emotional decision-making. Fear and greed. Those two emotions drive more bad decisions than anything else. Fear makes you sell at the bottom. Greed makes you buy at the top. And in a market that's driven by headlines, those emotions get amplified. So the question becomes, how do you stay grounded? How do you stay rational when everything around you is moving so fast? And for me, it comes down to a few key principles. First, focus on quality. In uncertain environments, quality wins. Companies with strong balance sheets, consistent earnings, real demand, those are the ones that tend to hold up best, and they're also the ones that recover fastest. Second, manage your risk. This is not about being right all the time. It's about protecting your downside. Because if you can limit your losses and let your winners run, you don't need to be perfect to succeed. Third, stay flexible. Don't get married to one narrative. Don't assume you've figured everything out, because the market will humble you very quickly. Be willing to adjust. Be willing to adapt. And finally, think long-term. Because while all of this short-term noise matters, it's not what ultimately drives wealth creation. What drives wealth is time in the market. It's staying invested in strong businesses, through cycles, through volatility, through uncertainty. Now let me bring this back to the key question. What should you actually do right now? And I'll give you my honest take. I think this is an environment where you want to be invested, but not overexposed. You want to participate, but with intention. Focus on high-conviction ideas. Add on weakness, not strength. Keep some cash ready for opportunities, and most importantly, don't let the headlines control your strategy. Because the market is always going to give you reasons to be afraid and reasons to be excited. But your job is to stay disciplined through both. Now, stepping back and looking at everything we've discussed, the ceasefire has reduced immediate risk. Earnings are still holding up. Interest rates, while elevated, are stabilizing. And sentiment is starting to shift. Those are constructive signals, but they're not guarantees. And that's the key takeaway. This is a market that's transitioning, not one that's fully resolved. And if you understand that, if you respect both the opportunity and the risk, that's where you can really start to position yourself intelligently. So instead of trying to predict every move, focus on building a strategy that works across different scenarios, because that's how you win in the long run. Not by being perfect, but by being prepared. If you enjoyed the video, like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Thanks for watching, and I'll see you in the next one.